And we'll cross now live to find out what's been happening in Europe. I'm joined now from London by James Shugg, Senior Economist at Westpac. James, take us through the day in London.
Hey, Tiki. Good evening. Look, actually, there was a little bit of optimism after initial sell-off at the very early open for European markets. But that optimism was driven by reports coming through that the European Central Bank had actually been buying the bonds, the government bonds of Spain and Italy. Now, they did put a statement out yesterday saying they were going to be looking at doing this, but they didn't actually name any specific countries. The fact that they actually were buying bonds on the first day gave the market some initial optimism, but it's evaporated. And it's evaporated big time. I mean, we've seen
is that partly because there's a view that the ECB just simply can't go on doing this?
No, well, I think that could be in some investors' minds, but the bigger factor driving the market down is that we've seen big losses on the commodity producers. It's the US economic slowdown and the slowdown in the global economy that people are continually factoring in that is the dominating theme. You know, financials are still up. The banks are up because they are the guys that get to flog the bonds to the European Central Bank. They get rid of their toxic assets and the European Central Bank takes them on. But it's other firms that are really being marked down, and but reflecting this view that the global economy is going to be a lot less robust than investors had been thinking until recently.
When we spoke to you last week, you actually said that the US economy could be on the cusp of a recession. We've now got an OECD report out today saying world growth has probably peaked. Are you more strongly of the view this week about a possible recession in the US?
Look, we're not forecasting a recession because we have to forecast the numbers that are published by the US government, by the statistician there. It won't be until next year when they publish benchmark revisions that take into account much more accurate data that will know whether the US is in recession at the moment or not. Our formal forecasts are 1.5% growth this year, 1.2% growth next year in the US economy. That's weak enough. I mean, that's the sort of growth rate that is going to see unemployment probably back around 10% before too long. And it's the sort of outcome that is going to probably push the Fed into a further round of easing. They can't cut interest rates, of course, but perhaps another round of quantitative easing. And
back to Europe, what about your confidence in the euro remaining intact? And we've just had one economist here, Professor Warwick McKibben, this evening, who's talked about a two-tiered Europe.
That's right, and that's been Warwick's view for a while, and I fully understand the arguments there. What I would say is that the euro is part of a much bigger process of European integration. I mean, for the last 70 years, Europeans haven't been killing each other every 20 years because they've become much more integrated, and the argument that a mere setback like the default of several European sovereigns could actually see the euro fall apart, I think misunderstands what the euro is really about. It's just one part of this broader process of making sure Europe never goes through the absolute human devastation and turmoil that we saw in much of the 19th and early part of the 20th centuries. And
briefly, do you think now that we're in a situation where the European sovereign debt crisis and the downgrade in the US are feeding on each other?
Yes, oh, absolutely. I mean, sovereign debt has become toxic globally. A few years ago, it was mortgage debt in America. But it's governments that have allowed their debt to grow to levels that are seen as unsustainable that are really in the focus. And in the case of the US, the issue there is that the assumptions that they use in terms of economic growth going forward are so optimistic, 3% growth over the next 5 years, when we think realistically it's going to be closer to 1%, that the already bad-looking numbers are really going to be a hell of a lot worse. So the situation is much worse than even the politicians in America are admitting to.
All right, James Shugg, we look forward to keeping in touch, but thank you for joining us tonight.
Thanks, Tiki.